So there come the first rates then, and clearly it's going to be all about earnings reactions given the kind of fall that you had in the Infy ADR overnight. While it's a 0.6% cut, 3.5% is the drag that you're seeing for Infosys alone. 14.15 is where that stock is. What's the case with HCL Technologies? Is there a further fall in TCS after yesterday's move? And I can see a whole lot of red across the IT screen right now. While HCL is actually jumping up 0.7%, TCS is dragging a little bit further, circling around that 35-30 odd level in trade. Wipro as well starts off in the red as we speak right now. SBI, after that brokerage downgrade, that stock also is seeing a bit of red. Let's just bring up that stock for you on your screens right now, because that too, after the downgrade coming in on SBI to a sell now, has started off in the red as we speak right now. So that's the key main stocks which are going to be in focus this morning. Now let's talk about some of the winners. Nuvama maintains their buy on NMDC. They've upped the target price to 188 from the earlier 143. Remember, these were big breakout stocks in trade yesterday. Today, it's a lot more tempered across that screen. What about Nalco, Gale? These were the other names. Bosch, PVR Inox. These were all which held out. Coal India saw a very decent move. NTPC, BPCL, these were all green ticks in yesterday's session. Some of them are continuing to maintain their green. Let's also talk about some of the pharma news flow. So Sun Pharma, Lupin in the green perhaps, because for Sun Pharma, the phase 4 trials are showing improvement in dry eye disease patients. Lupin has got a US FDA tentative nod for one of the oral solutions, a generic one at that. So relatively resilient in an otherwise weak market. Flat for Lupin as we speak, although DRL has had negative news flow. US FDA has issued 9 observations for their manufacturing facility in Hyderabad. So look out for that, what that stock does. Angel One, Anand Rathi. Those could be the big movers this morning, given very strong performance from there. Angel One has gapped up 3.6%, not seeing material excitement for Anand Rathi. Although the AUMs have risen up 10% there sequentially, they've raised their FY24 AUM and revenue guidance as well. And for Angel One as well, the gross client acquisition has come in higher by nearly 60% on a sequential basis, and the revenue as well has seen an uptick of nearly about 30%. Paytm Payments Bank has been fined just a very small amount, but fined regardless by the RBI on regulatory compliance issues. So look out for what that stock as well does in trade, 1% lower on that one. I'm almost rubbing my eyes in disbelief. Are we seeing a big recovery in IT? TCS is actually in the green, 0.5% higher right now. Let's see what Infy is up to. TCS has covered all of its losses. HCLTech is powering up ahead, 2.25% in the green for HCL Technologies. And even for Infy, that gap down is actually getting bought into, because that too has actually recovered nearly about 2% from its opening lows. 1431 is where Infy is right now in trade. So Kunal, firstly a word on IT, because it's really not all that bad as one thought it to be.
So yes, Aisha, I think it's a good recovery. 2% down for Infosys, 0.5% down or for the other names, 3.5% or rather 3% up for HCLTech. I think we would probably call this as a not so negative reaction for the IT index so far. And the good part is that many of the large cap IT names are still trading about their key moving averages. So I would expect that the markets have now probably built in a more of a absorption capacity to try and absorb the negativity in terms of results. This could actually be a good sign for the overall IT index. So would wait out for at least the first couple of hours, and if these stocks show signs of stability as well as more upside momentum, I think that's where one would probably look to trade on the upside. In terms of opening trade, DLF is something which looks attractive, and that's a stock which I believe did pretty well a couple of days back, had muted price action yesterday, could be bought into today as well.
All right, let's find out what Naresh makes of the trade setup this morning. And Naresh, lackluster, IT seeing a comeback, broader markets pretty quiet. What are you making of the initial trading ticks, and what would be your first trade?
So a much better tick as such. We've not seen a much larger dip of 150, 200 points. The first trade continues to be the same, looking at IndusInd Bank as an accumulate slowly and add on the way up.
Right, okay, that's the take coming in from both of our chartists on which way the trading day is going to pan out ahead, and it's really not all that bad. The market has showcased a fair amount of resilience, even While the GIFT Nifty earlier today was indicating a 170-point move down, we're at best just marginally lower. And very soon we've actually gotten back to that 19,700 print. And this, mind you, at a time when it's been a very weak handover from the globe. As we speak, Asia is pretty much still reeling under pressure. But let's make sense of all the chaos that's happening in the world. Puneeta Kumar Sinha joins us for exactly that. Puneeta, hi, morning. Good to have you on the show. Puneeta, just so much happening around the world. And now, of course, with the recent geopolitical tensions which have escalated in the Middle East. And clearly that impact is being felt with the cool off in the US bond yield as well. Would you say that the bond yield may have peaked out in the near term? And I ask purely because that's solely what's impacting equity markets across the globe.
Well, I think, first of all, the inflation number that came out today was a bit disappointing in the US. So, on the short end, I think rates are still high, whereas the long bond, although elevated, doesn't seem to be going up anymore because there's still some fears of a recession in the US, that, there is a view that we are kind of in a recession. I don't see signs of it, but there is talk that actually the earnings season might be reflecting that the earnings will show some kind of an earnings recession. But I think the rising geopolitical tensions, that's a big concern that I think markets seem to be ignoring. The liquidity is still strong in the markets, but if you look at the rising tensions across the globe, I think I hope this war doesn't escalate. But at the moment, I think the markets need to be a little bit more mindful of the rising tensions and the risks to global growth and global trade with all of this kind of escalating tensions. And to top it all, there is a lot of political upheaval also that's going on in many countries, including the US. Elections are coming up. So somehow the markets seem to be pretty sanguine, but I think there should be some kind of reality check.
Same's the case with us, right, Puneeta? Because next month we're going to step into state elections as well. Do you think tactically one needs to be a little bit neutral, offload some positions, take the chips off the table, keep the powder dry? Because from now up until the general elections, I'm guessing the market will throw up a lot of opportunities and it will be a volatile ride.
Yeah, I don't think it's the India elections that's going to create the volatility. I think the volatility is going to come from across the world. US elections, as I said, heightened geopolitical tensions, inflationary fears still across many markets. And then the China situation is still not stable. So while there is stimulus that the government is providing, I think the economy still needs a lot more support. And so all of that, I think, will create volatility going into the next few months. Now, India is in a sweet spot as compared to the rest of the world because of the growth that we have. And that growth and the demographic dividend, etc., is still very strong and is going to keep our economy relatively insulated and stable. And to a large extent, Indian small caps are demonstrating that decoupling. And but I think also the valuations in India are not cheap anymore because everybody is recognizing across the world that India is a sweet spot and a good place to be. And so everybody's investing, whether it's domestic investors, foreign investors, and that's raised the valuations of our markets. And so if there's any risks that come from the global tensions and that the stocks and the companies that have had the big are the traded. So I think one has to be definitely careful on some of those kinds of names that include some of the small caps and be a bit more defensive heading into the year end.
Puneeta, hi, morning. What is the outlook then when it comes to the overall election impact? Because we've got the 5 state elections and then, of course, the big Lok Sabha election next year. And what would be your outlook in terms of how you see the markets really faring or in the run-up and even during and post?
Well, I don't think anyone is really concerned about the general election because I think everybody knows and believes that Prime Minister Modi is going to, come back with a strong victory. On the state elections, I don't think there will be any significant surprises. So I don't think the markets need to be concerned about elections in India.
Enough reiterating that point there on the elections. But give us a sense then, Punita, as to what the outlook is when it comes to the overall earnings season, given the fact that you're saying India, in comparison to the rest of the globe, could remain fairly insulated. Will that really play out in earnings as well going forward? Could there be any sectors that could be in an especially sweet spot?
Well, I think the earnings season should be decent because all the issues that what we're seeing in the rest of the world haven't really impacted Indian earnings. India is pretty much a domestically driven economy, and so all the domestic driven companies which are relying on government capex, infrastructure spend, domestic demand, all of that is still strong, and so those sectors and companies are going to see decent growth and hopefully some margin. If I look at what the analyst expectations are, there is expectation of margin increases. I think the sectors, as we've seen in the results of Infosys and TCS, those are the kinds of companies that will be most impacted by any global cues, which is why you've seen like a little bit of a downbeat guidance coming from the results that have been announced so far. So I think the themes that have been playing out in India so far are likely to be the ones that are probably going to continue on the domestic side. And of course, one has to be very careful on the valuations and on the margin. I would think that would favor some of the larger cap names over some of the smaller cap names and some of the more defensive sectors that have been, relatively laggards compared to the really high-flying stocks, especially given the environment globally that we are. Of course, oil prices cooling off will continue to help India. India's own inflation, interest rate environment is fairly benign as well. So from an Indian perspective, I don't see significant concerns other than valuations.
Sure. Purnita, just picking up on the point that you were making about IT, clearly the one commonality in all the IT numbers which have come out right now is that they don't have visibility on when things are going to get better. And, like you rightly said, thereby cutting the guidance as well, keeping all that's happening around the world also in mind. But is this the time to actually start nibbling into IT when news flow is at its worst?
Well, IT, the valuations are pretty decent. And I would call IT now a defensive sector because it's also a high dividend yield sector. So it's generating a lot of cash. I wouldn't call IT a high growth sector anymore, but one that is more defensive, stable, and a kind of a core place to be in. So I think as the risks towards the global situation increase due to geopolitical tensions, IT may be a decent place to be in because I think that they have inherently a lot of cash on their balance sheet. And so even if there is a little bit of a slowdown, they can weather that through.
Sure, and I guess that's exactly what we're seeing play out in the market as well. Good recovery in the IT names actually from where they started off in trade. But Punita, good to have you on the show as always. Thanks for taking the time out. Since we're on the subject of IT, let me welcome on board the management as well of HCL Technologies, considering they are the ones which have actually performed the best so far out of all the IT names. Look at the way the stock has actually reacted, 3.5% higher thereabouts for HCL Technologies. Actually, not just HCL, even TCS. A quiet session for TCS to start off with, and now we've seen a meaningful recovery also play out, 0.5% higher for TCS, which was actually one of the biggest drags yesterday after its earnings, which came by day before post-market hours. Let's also check in on Infy because Infy also has seen a bit of a recovery actually from those opening lows, though you've not seen a material one at that, still down about almost 38 points or so. But let me welcome on board Vijay Kumar, the CEO and MD at HCL Technologies, also Pratik Agarwal, the CFO on board. Welcome both of you. Thank you so much for taking the time out and joining in. Mr. Vijay Kumar, if I could, start off with you. In the press conference yesterday, you sounded very confident about a sharp recovery and strong performance in the second half. What gives you this confidence, given that none of your peers have that?
Yes, I very clearly laid out what is our game plan for Q3 and Q4. First of all, Q3 has three big components that really contributes to the revenue buildup. First is we have a large deal which is going live in 1st of November that will contribute a reasonable amount of revenue for Q3. Software business, it is seasonally the best quarter. So you will see a spike in our software business in Q3. And all other bookings that we have done, they will contribute across different geographies, verticals. All of that will contribute into the growth for Q3. So putting all this together, we see, of course, there is a headwind, which is there is going to be furloughs in this quarter. We've considered all that, and we feel confident of a strong Q3. And followed by that, Q4, again, the large deal will have another step change in the growth. And then, of course, in January, the furloughs won't be there. So that revenue will also come back. So all of this adds up to these numbers.
So Pratik, let me pose the question a bit differently to you. The CQGR ask rate for next 2 or 3 quarters is 3 to 4%. Now this compares with 0.5% organic growth we saw in Q2. Now how will you achieve this 3 to 4% target? Because it's an aspirational number, but realistically, do you think it will happen?
So it is certainly not aspirational. Our aspirational goals are typically longer term in nature, and the guidance that we have given, the exact numbers for the next 2 quarters is 2.6 to 3.8% in each of the quarters. And we are very confident to meet that based on one, the large deal. So in Q3, you will have 2 months contribution, November and December. And then in the March quarter in Q4, we will have all the 3 months. So it will be like 1 month extra. So that deal itself, the size of the deal, 2.1 billion over 6 years. So the run rate for that is average works out to 330 million per annum. And that is the large part of the 2.6 to 3.8 range, which is services growth organic. Nothing to do with the ASAP acquisition, nothing to do with the software business. That is just services business organically growing at 2.6 to 3.8. I know it sounds different from what you've been hearing earlier, but yes, that's what we are confident of delivering. Absolutely.
Okay. And wanting to get in a take as well from you then, Mr. Vijay Kumar, as to what the outlook is that in Q2 that led to the poultry growth. Would you rate your client conversations as getting incrementally more positive, or spend environment, do you think, is the same as what we saw in Q1?
See, Q2, we would have loved to have another 1% or so growth. But it came at 0.5% because if you look at our services business, normally there is a services component and then there is an asset component. So our services component has grown probably a good 2%, but assets came down from 75 million to 50 million roughly. So that was a one-time thing. So that probably had an impact. So ideally, one has to look at the true services growth, which is much higher than the 0.5%.
Right. Vijay Kumar, what's the internal expectation for FY25? Given the strong deal wins, I guess one shouldn't rule out a double-digit growth for you for the fiscal FY25, that is?
I've always been mentioning that in the long term, this is a double-digit growth industry. Technology intensity is very high across all industries. A lot of fundamental business processes would get disrupted with AI, and Gen AI would really have a significant impact. But all of that requires the technology work, the underlying technology work to be done. So I would say long-term double-digit growth is what I'm expecting. But FY25 itself is a little difficult because of the reason there is a lot of volatility in different aspects of the business, right? In terms of how the ecosystem partners are looking at these opportunities, how are the decision makers looking at their own budgets coming into the next year, what are their business priorities, and these priorities also change. So we are really living in an environment where some of the business decisions are volatile. So it's too early to even get a sense of FY25.
So Pratik, a standout matrix this quarter was very strong margin beat. In Q3, do you see headwinds on account of wage hikes, or do you see this will be offset kicker? And Pratik, how's the pricing environment? If you can just quantify both of these things together for us.
Q3 is typically our best quarter for margins, led by the software revenue peak, which pretty much most of it flows down to the EBIT of the software business. If you see our last year, December quarter was 19.6% compared to 18% of Q2 last year. So this year Q2 is 18.5. So we should be hitting a peak in Q3 like we normally do on a seasonal expectations basis.
So Pratik, tell us a little bit more about the outlook on the pricing environment.
Pricing continues to be stable. There have been times in the past, couple of years back, I remember we called out, there were one or two deals which, we saw really irrational pricing behavior, but that is not the case now. We are not seeing any of that at this point in time. I mean, it can change very rapidly, as you can guess.
Mr. Vijaykumar, deal wins are very strong this quarter. There's no doubt about that. But how's the funnel of deal pipeline post this this conversion which is going to take place?
See, last quarter we did call out that our pipeline was at its highest, and that kind of commentary we had over the last 2 quarters, saying our pipeline was at its highest. Given that we've had significant conversions in the July, August, September quarter, the pipeline has come down. Having said that, our pipeline is still maybe 10% below the highest levels. So I would say our pipeline is very strong at this time.
So, CVK, what would be the deal rate going forward? Back to $2.5 billion per quarter?
No, I think our aspiration is 2 to 2.5. I think the point to be noted is our booking numbers that we disclose is the net new contracts that we sign, where we have a firm commitment of revenue for a certain period of time. This does not include renewals. This does not include rate card and framework deals. So to that extent, a 2 billion incremental new business being signed every quarter is a very strong growth driver for the company.
And Pratik, the headcount reduction, is this going to be the trend over the next couple of quarters, according to you?
No, I don't expect that in the next couple of quarters. Basically because, the growth that we have talked about, based on the guidance, if you back calculate 2.6 to 3.8%, that will not kind of happen. We've cut down because we needed to, and we did not need to backfill all the people that were attriting. basically because the freshers that we hired in the prior 12 months or so are now ready and raring to go. And we are all raring to go after the 2.6 and 3.8 range now.
Right, Mr. Vijay Kumar, Prateek, both of you, thank you so much for taking the time out and joining in. Yours perhaps is the only stock which is actually comfortably in the green after its earnings, 2.6% higher for HCL Technologies as we speak. On that note, we're going to take a very quick break, but come right back. Lots more discussions lined up on the other side. Okay, back with the market right here in ET. Now, let's just revisit because the market is taking an intriguing turn. While the Nifty is still down about almost 0.5% or so, it's really all over the place within IT. HCL Technologies now up 3% as we speak. Infosys seeing a fresh wave of a selling. It did see a bit of a rebound. From there, it's slipping again. 3% lower for Infi as we speak. And then TCS is the one which is, sort of flickering in and out of the green to the red. Now comfortably in the green, about a 0.5% uptick is what you're seeing on TCS futures right now. So, yeah, net, you've got the Nifty IT index, which is flat, and it looking at the way the Infi ADR crashed last night, was down about almost 6.5% or so. One wouldn't have thought that Nifty IT could have been so resilient in trade. ONGC, Tata Consumer, these are some of the names which are holding out. Bharti, SBI Life, Nestle, etc. But the bigger traction is in an idea, Petronet LNG, GAIL for a second consecutive day. That stock is up 2%. And HDFC AMC is the one which is right on top there, 4.5% higher as we speak right now. But let's talk about India's renewable roadmap. Let me welcome on board Vinay Rustagi, the MD at Bridge to India, joining in on the show right now. Vinay, hi, good morning. Great to have you today on ET Now. Thanks for taking the time out. Vinay, as per our analysis, India needs to add about 400 gigawatt of RE capacity to meet its target of 500 gigawatt by 2030 vision. What kind of growth opportunities can we expect emerging from this?
Yeah, hi. Thank you and good morning. Thanks for having me. So clearly, India is very heavily dependent on coal. The government has announced very ambitious targets for the sector. So, just to give you some context, we've been adding about 12 to 13 gigawatts per annum. So really the potential is to double and triple the sector's growth rate going forward. So there is a huge potential, but we also need to be mindful that there are issues in terms of land transmission, financing, etc., that need to be addressed for the growth potential to be realized.
So what are the short-term and medium-term challenges, though, for the renewable energy sector? Because I'm guessing there would be many.
Yes, that's correct. So, one is renewable is a variable source of power. It is not always available when the consumer demands it because it is dependent on the solar resource or the wind resource. So which means that variability needs to be factored in and we always need a backup source of power, which could be hydro, thermal, gas, or increasingly storage, some kind of a storage technology. And these alternate sources of power or backup sources of power are extremely expensive. So that is one challenge. Second is renewable is a very land and transmission intensive source of power. Of course, in a country like ours, land acquisition tends to be very expensive, very complex, very time consuming. Just to give you an idea, we need more than 1 lakh acres of land every year to realize the government's vision of 40 gigawatts per annum. And that's massive. And we already see with the existing, 12 to 13 gigawatts land is already a challenge. So that is one very big challenge. Second is there is a huge need for investment in the expansion of the transmission grid, which again takes time. Transmission typically takes 5 to 7 years to set up, whereas renewable projects have a gestation period of only about 2 years. And the third, I would say, is obviously it is very, very expensive. Together with renewables, storage, and transmission, we are looking at a capex of somewhere around $300 billion over the next 7 years. So these are the various challenges which need to be taken care of to realize the growth potential.
All right, Vinay, I just wanted to also understand from you what the outlook is on new ancillary segments in the RE segment, which according to you are showing green shoots. What kind of opportunities are you seeing in the value chain?
So yeah, I mean, look, I think one is the government pivoted towards Make in India about 2 or 3 years ago. So there is we are still very, very dependent on China, particularly for solar equipment, increasingly for storage equipment. And then with government now saying that we have to be self-sufficient, together with all the other policy initiatives like customs duty, PLI, etc., there is a huge opportunity for bringing manufacturing onshore, and not only for the domestic market, but also for supplying to other countries like US, Germany, Japan, etc., etc. So manufacturing is one. Second, I would say, is the distributed renewable market, both for supplying to the residential consumers as well as the corporate consumers. And these are huge markets which we believe are still relatively untapped. So that is, again, which could be actually accounting for almost half of government's target. So that is another very big opportunity, both in terms of construction of projects and financing and development. The third thing I would say is the storage. Storage, we are still, I would say, very, very slow movers. But there is opportunity opening up for pump storage, battery storage, both for manufacturing as well as deployment.
Let's talk about specifics here, and let's talk about specifics in terms of wind, solar. Now the wind has not been a great success story in India, even though companies like Suzlon and some other companies have started way back in 2000. We've not seen too much of commercial success via the wind generation route. Why is that?
So, what happened in wind is that we used to have a feed-in tariff-based regime, which means the government was offering fixed tariffs to project developers. And that was a very stable, attractive regime for the investors. Now that regime, under that regime, we were doing about 3 to 4 gigawatts per annum. And then suddenly around 2017-18, we pivoted very sharply towards a competitive bidding-based regime. Now, as very often happens in India, when you have a competitive bidding scenario, the tariffs went down to very unrealistic levels, which put a lot of pressure on the investors as well as the whole supply chain. And many of these projects which were bid during 2019, 2020, etc., they were actually unviable, and many of those projects had to be abandoned. So that is one reason why wind has slowed down. Second, of course, is that because of COVID, because of Ukraine war, etc., there has been, we have seen a massive disruption in the supply of commodities, price cycle, etc., because of which the cost of equipment has gone up. So these two things together meant that wind has seen a really, really tough time over the last, 3-4 years. Having said that, I think we are turning the corner because commodity prices have stabilized. Many of these companies, including Suzlon, as you mentioned, have restructured and now are in a much better position, having raised new money to grow and scale up. Also, the sector has learned a lot. The supply chain has learned a lot. Machine efficiencies have improved. Technology has improved. The other very big factor in favor of wind is that wind is a diversified. It is the output profile of wind is actually quite diversified in relation to solar. So you can't keep on adding more solar capacity. The more solar you add, the more wind we need to make sure that we have even supply of power during the day and through the year. So which means that supply chain is improving, costs are coming down, the grid needs more wind power, and the result is that we do expect that the wind outlook is becoming much more positive. We expect the sector to grow from, say, about 2 gigawatt per annum right now to something like 6 to 7 gigawatts in the short to medium term.
Now let's talk about solar specifically. Rates have come down from 15 rupees a unit to about 2.5 to 3 rupees a unit. India has added more capacity than what America has added in last 12 months. That's the data what I have read somewhere. So my question is that if the Indian solar sector is such a big success story, why is that the developers who set up the solar capacity, they are telling us a very different story. I mean, if I look at the companies which are doing development of solar, who are the developers per se, they are still crying for duty protection. They're still talking about Chinese imports, and they're still talking about lack of, right funding and viability. Is that true?
Yes. So, we have to differentiate growth with profitability. The sector, as you say, has been growing quite rapidly. But again, mind you, we added 12 gigawatts of solar last year, but that was way below the government's targets, almost, I would say, 40 to 50% below the government's targets for the year. Having said that, yes, growth is there. Yes, investment is coming in. But the challenge with solar is that it is a very open commoditized technology. And when you have everything going through a competitive bidding process in which prices are, bidding is very, very aggressive, the returns are being squeezed out. And I can just give you an example that, 5 or 6 years ago, developers were hoping to make 15 to 18% kind of equity returns from these solar projects. Today, the returns are barely in low teens, very often lower than that. And that is quite challenging because the cost of capital has gone up. There is also competition for capital from other countries, US, Europe, Japan, etc., have set in place very, very attractive policies to attract investors. As a result, capital is becoming more expensive, and these returns of 12 to 13% are no longer very attractive. So, in a very commoditized sector, growth is there, but profitability is still kind of, I would say, the holy grail for most investors and project developers.
Very great to have you on the show today and give us color on how India's renewable energy roadmap is looking like.
Thank you so much. Thanks for having me.
We'll take a very quick break on that note. It's status quo really for the index, which is circling around that 19,700 mark, and that's a big block deal on HDFC Bank, by the way. 43 lakh shares have traded hands, and by the way, HDFC Bank is slated to come out with its numbers this weekend itself. So ahead of that, you're seeing a big block deal. 1541 on HDFC Bank as we speak. We'll take a very quick break, come right back, got a discussion on where bond markets are headed on the other side.
Now, bond yields, well, they shot up after the credit policy because of the new instrument which Reserve Bank of India had indicated that they would start using it ahead of the India's bond inclusion. But post the inflation number, 5.6, I like the ring of inflation when it is always below 6. And I think bond markets are also liking the ring of inflation when it is at 5.6 ahead of the festival season. And B. Prasanna, I'm sure, will also like the ring of inflation when it is below 6. So Prasanna, good morning. Thank you for joining us. I like the ring when I say every time inflation 6% ke niche. Now let's understand that inflation number which has come yesterday below 6%. Should we take heart from that? Should we assume that this is going to be more than just a mathematical and a transient phase?
Hi, good morning, Nikanj, and thanks for having me. Yes, it is true that it was actually a double delight for India yesterday when headline inflation came down to closer to 5%, and even the IIP, there was an upside in the numbers that came out. As far as inflation is concerned, yes, you're right. We can take heart from the fact that not only the headline inflation, but even the core inflation has actually fallen. Core inflation is something that RBI tracks, excluding food and fuel, which are a little bit more volatile. So getting a number closer to 4.5% indicates that well and truly the generalized inflation pressures are on the way down. And on the food inflation side, very clearly what we saw in the last 2 months was a very temporary spike in inflation led by vegetables like, tomatoes and all that. And there has been a real fast reversal in those prices. Despite, monsoon not really being as normal as it normally is. So from that perspective, I think there have been very good price management from the government, and RBI has also done its bit in terms of controlling generalized inflation pressures. So all in all, I think positive inflation data. Not that the market did not expect, the market or the analyst community expected it to come down to 5.2, but coming to close to 5%, I think was slightly better than expected.
Okay, now with inflation at 5% and the fact that festival season starts now, do you think this inflation print could be challenged? Because the monsoon effect is something which now will be visible going forward. And now that festival season is round the corner, do you think 5% could come back mathematically above 6.5 again?
So I think, Nikunj, the way to look at inflation is to, look at it from both what is happening to the sequential inflation, which is the month-on-month numbers, and what is happening to the year-on-year inflation, which in turn includes the base effect. So in all perspectives, I think the near-term inflation, which is the October inflation that we would see, is possibly going to, which we will see in November, will possibly be closer to the 4.5% kind of levels, which means slightly lower than what we are seeing even now. But I think that will be possibly the best inflation that you would see over the next 4-5 months. And after that, sequentially, we'll probably see it going back to 5% handle, hopefully not the 6% handle. And after that, we'll see over the next 1 year inflation coming down to the 4% handle in Q2 of FY25. I think the story is that broadly inflation pressures are well contained, and the spike that we saw, which led to a lot of fears that it's going out of control, has turned out to be very, very temporary. And I think we're back to the long-term trajectory of inflation inching towards the 4% mark. But bear in mind, we still don't see actual 4% mark getting hit over the next 1 year.
Okay. Jayesh Mehta, let's talk about bond yields specifically. Last week was a bit of a scare when bond yields after the credit policy shot up. And now post-inflation, bond yields have not really, can bond yields come back to normal levels post the inflation data? Jayesh?
I think currently what we are seeing is, if you really look at it, what was the general public poll expectation from the RBI on the policy, right? It was supposed to be a hawkish pause, right? And that's what RBI actually did, right? So at that point of time, you didn't do any action on the hawkish side, but you did make a couple of announcements, that is, 4 is the target, and we might do OMO sales for liquidity purpose. Very well clarified in the press conference also. But that also depends a lot on where US yields were, right? So I think that where the US yields were, that's where the market was a little heavy, and they did consider that. And that's where we spiked up. I think it will still now track US yields tomorrow. It doesn't look like, but if hypothetically, if US yields drop down, then definitely we'll see some relief there on the bond side. But as of right now, yes, the market is kind of going, and typically we have this, this particular quarter, October, November, December, from a demand perspective, also a little bit weaker historically. And that's where people are just keeping off the little bit of the position. So I think I would look at it not really, coming up very quickly unless US yields come down, or maybe we see much softer inflation print, which doesn't look like coming very quickly.
Prasanna, now let's look at the global macros here. We've talked about vegetable prices, bhindi, tomato, that's all fine. But globally, we are also talking about a Fed, which is hawkish. We are looking at US economy, which was supposed to hit a soft landing patch. It is unlikely to hit that. And then you got China, which was supposed to recover, has not recovered. Europe was supposed to slip into recession, which it has not slipped. So they are looking at a lot of moving parts, aren't we, Prasanna?
No, I mean, that's all in the game, isn't it? I mean, that's why markets are markets. I mean, there are a lot of moving parts. So the thing on Fed and the US is that the data has been continuously coming on the stronger side. And yesterday's inflation print from the US also clearly indicated that it's still not yet slowing down to the level that policymakers will be interested. But what is also interesting is that the irony is that the entire bond yield move that we have seen over the last 2 weeks or so is also a reflection of the kind of fiscal pressures that are prevalent in the US, with the US government, spending quite a bit and the fiscal deficit being at a much, much higher level than, what was common in pre-COVID levels. So it was actually inflation which was led a lot of it by fiscal policy. But unfortunately, it was monetary policy which was taking on the full might of controlling inflation. And in kind of an ironical twist, it is now the fiscal which has again come back in terms of borrowing program to lift the bond yields up, which in turn is actually helping the Fed with the financial conditions index tightening. So it's quite possible that the Fed might not need to go and do the next 1 or 2 hikes that they would have otherwise probably done in order to control inflation. So what I'm broadly saying is that the financial conditions index has tightened substantially, even though the Fed has not done much over the last 1 or 2 months. So we do expect the base case scenario for the Fed to not hike anymore. But having said that, I mean, like you said, it's always a moving part. Growth is always, we need to look at data at all points of time. The labor market is not really slowed down in the US. The rebalancing which the Fed has been trying to engineer has still not happened. And unless that happens, you can't really get comfort from a long-term inflation perspective. So all in all, yeah, interesting times continue. We need to keep looking at data. But having said all of that, I still want to, kind of bet that Fed is kind of, done its peak in terms of rate hikes. And maybe sometime in the middle of next financial year, calendar year, they might start looking at initial cut.
Jayesh Mehta, just to draw your attention back to the current 10-year, which is at 7.31 instead of 7.29. So my point is that if inflation is down, what I've read in financial books is that if inflation goes down and if it is better than expected, yield should actually come down. ये तो उल्टा हो रहा है.
So, is that to me?
Yes. I ask you all the difficult questions now.
So let us put it slightly differently also. When we had index inclusion, right, the yields actually went higher, right? That guys also must be surprised that we have never seen anything like this. Like we got India into index inclusion, and that day, of course, it came off and closed the day at higher than the previous day. So that was kind of priced in. I think as Prasanna also said earlier, market was expecting 5.2 inflation, but it's again, as I'm saying right now, more than India macro, it is kind of tracking the US macro to an extent. Little bit of relief there today is on the OIS. There's no much change, so that's like people are thinking that like it's a relief kind of a situation. So from that perspective, at this juncture, people are on the lookout. Of course, if we didn't have index inclusion, even though nothing changes on our macro, we would be much higher in terms of yield at this juncture because of what's happening globally. Now, of course, it's again a mindset issue. It's over a period of time. People will know. But, I cannot resist, Nikunj, what Prasanna was talking about, monetary and fiscal. So I can lightly say that US is going through what we went through in 2009 to 2013, where monetary was trying to do certain things and fiscal was doing something differently on the inflation side of it.
All right, gentlemen. Thank you very much. By the way, which one of you is going for the cricket match tomorrow?
Not me.
Neither.
we have a lot of excitement in the markets, right?
Come on, India, Pakistan and bond market, come on. India, Pakistan is more exciting. Jayesh bhai, be realistic.
I'm not really into cricket as such. So for me,
Nikunj, show the match live on ET now. We'll watch ET now.
No. See, we will keep the screen full with exciting. So Saturday afternoon, do tune in. I'm sure I can promise you the cricket update would be there.
Okay.
Enjoy your day and enjoy the rest of the week. Thank you very much, gentlemen. And always a pleasure to have you and to get your thoughts on which way the bond market and which way the macros in the world are moving. Markets, meanwhile, what do we have? Before that, let me mark what is the report coming from Citi on Nestle. Now, Nestle is a stock which has honestly fallen off the radar for a lot of market men right now because it's expensive, growth concerns, inflation concerns, milk prices, vegetable prices. If inflation is coming down, is it time to go back to FMCG? Let's look at it. Is Nestle the odd one out? Let's look at Tata Global. Let's look at actually food companies. BKG, QSR, Nestle, Tata Consumer. These are the names which you want to look at right now when it comes to the entire change in terms of the inflation basket. Rajiv Ratan, chairman of Ratan India Group, joins us now. Let's connect with him to understand that what he makes of the current environment in the e-commerce space. Rajiv, good morning. Thank you for joining us. Rajiv, on the retail commerce, the EOSS last time around, there was a very tepid response to discretionary consumption. And now that we are moving towards the festive season, do you see things changing in the e-commerce front, at least on the e-commerce website?
Thanks. From our side, I can talk about my business versus overall macro. We started in March of 22, and within first year of operations, we scaled up to revenues of 4,000 crores. We are present across India. We have served over 19,000 pin codes, which is 99.5% of the country. We stock about 40 lakh plus items. And we, like in this Q1 of current financial year, we served 2 crore plus orders. So from our side, we have been on the growth path. We are not seeing much of challenges, but yes, festive season is always special. It accounts for a big chunk of sales that get pushed around, and we are seeing a good response.
Rajiv, so help us understand, given that you have presence in a wide number of geographies, what's your visibility about how the rural versus urban trend is panning out? Are you witnessing any green shoots anywhere? What are the demand trends across the country looking like?
So it's very difficult to pinpoint right away if you're specifically talking about the current festive season. Data is still coming in and being listed. We will declare our results soon for the past quarter. Having said that, in our business since inception, we've sold 3 crore apparel. We've shipped 2 crore shoes, 2 crore books, 2 crore wireless accessories. So the scale of operation is huge on our side. We've tied up with 135 fulfillment centers across the country. And since I've said that we've served across all the pin codes of the country, so we are present everywhere, and that is something which feels great because we just started not too long ago, and we are amongst the few companies which were able to scale up from 0 to 4,000 crores. Our current run rate is about 5,000 crores, and we expect that this business should keep growing at 20-25% growth year on year. And that obviously is because e-commerce in the country is growing. People are the shift that happened during COVID towards e-commerce is some of that has stayed on and is only adding to the ease of convenience that you get while buying online versus offline.
Which are the categories where the growth, the $1 billion is a very impressive number, where the growth has been the strongest?
See, we are seeing good growth across, we have 5-6 categories, and across the categories we are seeing good growth, more so in apparel, books, shoes. We are seeing good growth.
Interesting. Let's also get in a sense as to what the outlook is as well when it comes to how the newly launched brands have performed. Do you believe that the segments that you would target would be more value or premium?
So these brands have been launched recently, just like a few months ago. So it's early days. Brand building is a journey. So we've embarked on the journey, and we are seeing a solid response. It is beyond our expectations, and we are very much encouraged. And also at the same time, we take inputs from our consumers very, very seriously, and based on customer feedback, we keep doing changes around it. Our Cocoa Blue is rated 4.5 star on Amazon platform, and that we take extremely seriously. So we are on a solid journey vis-a-vis our brands, and because they are just early movers. But yes, they've been launched at price points which are not premium today, but we will soon be moving towards some of the styles will probably move towards premium segment as well.
When I scan through your presentation, and if I look at the profiling of the group, there is a lot of emphasis on drone delivery, Neo Sky, drone delivery. How realistic is that that entire mechanism of delivery? Because it's great that drones are being used to deliver, but globally it's not been a very successful mode, so to speak, right now. What's happening with Ratan India?
Yeah, so we have drone delivery capability as we speak, and it has been tested. In fact, the BV loss, which is beyond visual line of sight, it's called BV loss in aviation parlance. So that those trials were done. So our company was the only one which was successful in that trial. And so capability is absolutely there. It is only a matter of time. And it is going to happen. There is work happening both at government level and at enterprises level about traffic management. And once those rules are out, every drone in this segment will have to be logging into a central system, and hence the traffic will get managed, and then I don't see much of an issue. It is surely a business which will scale up in times to come. Yes, you are right. It has not scaled up extremely well, but from our group, we have an investment in Metanet company, which is actually doing drone deliveries in Switzerland and US, and they are performing extremely well. And we've seen those operations, and they are. It seems too much futuristic, but it is not. It is something that is waiting to happen.
All right, really appreciate your time, and thank you for joining us. Markets, meanwhile, well, where do we stand? Last trading day of the week. It's been a good week, actually. If you look at the market in terms of the aggregate spirit, I mean, it's a week when we were struck with this entire geopolitical ripple globally. And the ability of the market to climb the wall of worry, shrug off the bad news, ignore what is important, ignore what is not market moving, ignore sometimes the noise, I think has been quite extraordinary. The mid and the small cap stocks specifically have really hit out of the park. IT, if that was not a drag today, I think the market would have looked completely different. But 1 week, which is last Friday to today, if you look at the 1 week change, you look at the news which was thrown at the market this week. It was geopolitical problems in Middle East. Israel got attacked, and despite that, IT index, take it out, the mid cap index is up, the Nifty is up, the small cap index is well in the green. And that's the beauty of the market, that Indian markets, they continue to chug along and they continue to climb the wall of worry. So keep the faith going, and I think that is the message from the market this week. Let's take a break. So far the news is that Infosys is down, but rest of the IT back has to come.